So now let's take a look at when we long a put. Again, a basic strategy for going short on the market. So as when we buy a call, recall that we've got a Nike sign, which is something like that. All right, we've seen it very, very often. We have got that Nike sign that goes like that. That's buying the call. So just remember, when you buy a put, it's the mirror image. Imagine there's a mirror over here and you just flips it around like so. So that's what a put looks like. So again, a put loses when the price goes up. But when the price goes down, you're making money. So when do we deploy a long put? When we are very bearish on the stock or the ETF or the index, and we expect the price to move down sharply in a short period of time. And just like call options, we buy put options when they are relatively cheap, when there's low implied volatility. As I've mentioned, we look at IV percentile on the trading platform, and if it's below 40%, options are cheap. And if they're above 50%, I would caution against buying options unless you're really, really so confident that it's going to move sharply in one direction. Next, we deploy this strategy when we're going for really high risk, very high reward trades. And we again deploy this when we are really bearish. So we want to ensure that the stock which we are buying the put on is a low momentum stock. Again, in the lesson on technical analysis, you know that a low momentum stock has a relative strength which is falling against the S&P 500. So it's a very weak stock, and again, you want high volume as well. And you want to see a specific setup where the price is breaking down from a consolidation pattern. So it's consolidating in a consolidation, and it breaks down into a new downtrend. So the example on the left, you can see the price is consolidating, going sideways with a strong support at 33, and it breaks the support and falls all the way down. So that's the precise time you want to buy the put. Or the price is bouncing off a resistance on a downtrend. So on the right, you see the stock on a clear downtrend, making lower highs and lower lows. And again, a clear downtrend is signaled when you have the moving averages sloping down with the biggest moving average above the smallest moving average. And you want to short when the price hits one of the moving averages as a resistance. In this case, it's hitting the 50 moving average. So we anticipate the price is going to go down. We buy a put right at that point of time. So this is when we deploy a long put. So let's take a look at an example where I would buy a put. So over here, we have got EQT. This stock's on a clear downtrend. You can see the price action making lower highs and lower lows, right? And you can see that it finds resistance at the 50 moving average. Hits the 50, comes down. Hits the 50, comes down. So that blue line, the 50 moving average, is a strong resistance. So the moment it hits it, comes down, we want to short the stock. So you can see over here, the price is going up. And over here, it hits the 50 moving average resistance at $20. So we anticipate that the price is going to go all the way back down to continue the downtrend. So right at that point of time, we're going to buy a put. So the price, the market price at a point of time is $20. And I anticipate that the price is going to go down to $16 within the next month or so. So I'm going to enter at $20. My target price is $16. So how could I take the trade? Well, I'll buy a put. I could buy a put at the money. So if I buy an at the money put, it would be a 20 put. So 20 would be the strike price. And again, I take a look at the option chain and I select my date to expiration. So I always want to ensure I've got at least 60 days to expiration. So I'm choosing the February put because now it's December to February, I've got at least 60 days. So in this case, it's 66 days to expiration. So that's fine. And this is my strike price, which is at the market price. So it is at the money. So what would the risk to return profile look like? It looks something like that. So again, the first thing would be to draw your risk to return graph. You have got profit over there, loss over there on the y-axis. On the x-axis, you have got the stock price. So that's moving up, that's moving down. So the first thing would be to check what's your maximum risk of the trade. So the maximum risk is the premium that is paid. In this case, the premium is $2 premium. And if you buy one contract, that's 100 shares, so your total risk is $200. That's your max risk. So there we are, your max risk would be $200. And this would happen if the stock price goes up, that's the max you would lose over there. Next, what's the break-even price at expiration? So again, this graph that you see, the thick one, represents the profit and loss at expiration when there's no more extrinsic value, purely intrinsic value. It's either out of the money or in the money, or at the money. Okay, so at the money, out of the money, no intrinsic value, option expires worthless. If it's in the money, there is intrinsic value left. So the break-even price would be the strike price minus the premium. In this case, $20 is my strike price. So I deduct the premium. So that's $18. So there we go, $18 over here. That is my break-even price. So currently the stock price is at $20. It has to go below $18 for me to make money at expiration. Because at expiration, I have to cover my premium beyond my strike price. Finally, what is the profit I can expect if the stock goes to my target price? So in this case, my target price is $16 based on the chart. I expected it to go to $16. So if the stock goes to $16, what happens? My strike price is $20. So I take my strike price minus my stock price. That gives me the intrinsic value of the option. And I have to deduct the premium that I paid to get the net profit. Correct? Okay, so $20 minus $16 is $4. $4 minus $2 is $2. So my net profit will be $2 at expiration. Multiplied by 100 shares, that's $200. So again, you may be saying, hey, I'm risking $200 to make $200. Risking one to make one. Are you sure that's a good deal? Well, again, like I mentioned, we do not allow ourselves to lose the maximum premium. Usually, when it loses 50% of the value, I cut my loss, which means my actual risk is about $100. And at the same time, I would tend to sell my option before expiration, which means if I do that, I would get more than $200 because I have extrinsic value left in the option I sell, so the option's worth a bit more. So again, notice that this thick graph, this thick line, you see that is the profit at expiration. But this dotted line that you see is the profit now, today, which is 66 days to expiration. Remember, I am buying the February expiry. So from December to February, I've got 66 days left. And notice that as the option moves to expiration, the chart or the line would slowly move to the left till it reaches the thick line, which is the expiration line. So currently, while I have 66 days left, my break even is at $20, which is where I buy it right now. So notice that if I were to buy the option right now and sell it right now, I'll break even at $20. But if I wait to expiration, the break even becomes $18. So the longer I wait and the closer I get to expiration, the more difficult it is to break even because the price has to fall more for me to break even. But before it expires, I can break even at a higher price. It doesn't have to fall as much. Also notice that if the price can fall to $16 before expiration, you will see that I would potentially make a lot more than $200. I could make maybe $300 or $400 because I'm using this dotted line as my reference and not this line, which is the one at expiration. Got it? So now it's your turn. Let me give you an example, and I want you to calculate the break even, the max loss, and so on and so forth. So let's take a look at Facebook. Facebook is on a clear downtrend. Moving averages are sloping down. The smallest moving averages are above the biggest moving averages, and you see a clear pattern of lower highs and lower lows. So this is a clear downtrend, and we expect it to go down from here. And it's currently finding the resistance again at the 50 moving average. So the current price of Facebook is 145. We expect it to go down to 125 in the next month or so. That's our target price. So you decide to buy one contract of Facebook shares at the February expiration date. So that's more than 60 days to expiration. And we buy the 145 put, which is at the money. So since it is currently at 145, we buy the 145 put, we're buying at the money, and our premium is $10. From the option chain, you can check the premium. So I've checked it, and there it is. So with this scenario, I'd like you to pause the video, and I would like you right now to write down the answers to these 5 questions. Number 1, how much would it cost to buy one contract of Facebook put options? What's your maximum risk? What's your break-even point at expiration? Again, hint, 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 take the strike price and deduct the premium. Next, if Facebook drops to 125 by the expiration date, what is the minimum profit you expect to earn? So again, the hint would be take the strike price minus the stop price and minus the premium. That will give you your minimum profit. Finally, I'd like you to draw the risk to return graph, which is that Nike sign mirror image showing the maximum risk, the break even, and the profit at expiration. Please pause the video and do it now. Welcome back. Let's go through your answers. How much does it cost to buy one put contract for Facebook? So what's your premium? Well, from the previous slide, we said your premium is $10. So what's the total premium you pay with one contract? That's right, $10 multiplied by 100 shares, and that gives you $1,000. So $10 multiplied by 100 shares, that would give you $1,000. So that's the cost to buy one contract of Facebook puts. All right. So what's your maximum risk? If you don't do anything, you allow the puts to expire worthless. At expiration, you lose your entire premium. So the maximum risk is the total premium you pay, which is $1,000. Have you got that? Great. So next, what is your break-even price? So the break-even price would be the strike price minus the premium, which would be, again, the strike price is 145. The premium is $10. So the break-even price would be 135. There we go. So at expiration, recall there's no more extrinsic value. So the only value will be intrinsic value. So if the option expires in the money, it's worth something. If it expires at or out of the money, it is worth nothing. So the break-even price will be 135. The price has to drop to 135 or below for you to make money, or 135 for you to break even. Next, if Facebook drops to 125 before expiration date, what's the minimum profit you would earn? All right, so the answer would be the strike price minus the stop price minus the premium. So again, the strike price is 145, and the stop price in this case is 125 if it drops to 125, and the premium is $10. So the minimum profit you would make would be $10 multiplied by 100 shares. So your minimum profit at expiration would be $1,000. There you go. So again, if you were to sell the option before expiration, you would make more than $1,000 because you would have the extrinsic value as well. But at expiration, there's no more extrinsic value. So what you're left with is the intrinsic value that is in the money, which is $1,000. So that's why we call it minimum profit, because you should make more than that by exiting the trade before expiration. Finally, draw the risk to return graph to show the maximum risk, the break-even point, and the profit if the stock reaches $125. All right, so let's take a look at how you draw the graph right now. I assume you've drawn it, so let's check if you got it correct. And first thing to do when you draw the graph, again, is to draw the y-axis. And that's the profit, that's the loss. And we've got the x-axis. And this is the stock price. Okay, great. So first of all, what does a put look like? A call is your Nike sign. Your put is an inverse Nike sign, a mirror image of the Nike sign. So it should look something like that. There you go. So that's your put, right? So what's your maximum loss? Oops. Let me draw that again. Okay. So my maximum loss would be $10, which is the premium multiplied by 100 shares. So it's $1,000. So minus $1,000. 1, 2, 3. So that's my maximum loss if the price goes up. All right. So next, what's my break-even price? So the break-even is over here. You know, that's when I break even, because it's zero. I'm making money, I'm losing money. So this this graph that you see again is the profit and loss at expiration. All right, the P&L at expiration. So my break-even, as I calculated, was 135. So this is 135. That's 135. $135. There we go. That's my break-even at expiration, right? Okay, and we said if the price goes to 125, if it drops to 125, how much do I make? Right? So I would make, again, it's not drawn to scale, so I'll make $1,000. 1, 2, 3. There you go. Right? All right. So if the price drops to 125, I make at least $1,000. I say the word at least because I could make more than that if I sell before expiration, and I've got some extrinsic value on top of my intrinsic value. So again, that is the chart of the expiration date. So again, if you were to buy the put option right now, what does it look like 60 days to expiration? It will look like something like that. Let me use another line. It would probably look something like that. Yeah. Okay, something like that. And this over here, this would be the strike price, which is 145. So currently when I buy the put option, my break even is the strike price right here. But again, the longer I wait, as it moves to expiration, what happens? It gets more and more difficult to break even, because the break even price begins to go from 145 to 135. So which means that the stock price has to fall a lot more for me to break even, right? But if I were to exit before the expiration date, I could break even even before it reaches 135. I could break even at 137 or 140, something like that. And again, if the price falls to 125 before expiration, you can see that I would make more money than $1,000. I could make maybe $1,500, for example, or $1,200, because again, the difference between the dotted line and the ball line, the difference will be the extrinsic value. So again, when you're putting in an actual trade, you would use the chart analyzer on the trading platform, and they'll plot this graph for you. You can see exactly how much you would make or how much you would lose at different points in time. So let's now run through the advantages of risk of buying puts. So again, the main advantage of buying puts is limited risk. So the most you can lose the premium paid, and you have well, almost unlimited potential return. If the stock goes to zero, you maximize your return. Puts allow you to control high price stocks with minimal capital, and they allow you to magnify your returns because with very little capital or premium, you control a large quantity of stock. So you are able to get 100% return easily on any trade that works out well. So for example, if the premium is $400 to make a $400 profit, which is 100% return, is a pretty normal trade outcome. So what is the main risk of buying straight puts compared to other more advanced strategies you will learn in the next part of the course? Well, the main risk, again, when you buy a straight put or a straight call, it is relatively expensive compared to a put spread, which you'll learn in the later lessons. Because when you just buy a put, you're paying the premium, and to break even, the stock price has to move past, or rather the stock price has to move past the strike price and the premium by expiration for you to profit from it. So even if the stock price moves down, but it does not move down enough past the premium, you will end up losing money on the trade. Again, we can mitigate this by exiting our put option way before the expiration date. So our break-even price is a lot higher and doesn't have to go down that much. Next, we risk losing money when we buy puts if the price does not make a large move down within the expiration date. So again, we buy puts because we are bearish on a stock or on an index. So just because it goes down doesn't mean we make money. If it goes down but not enough, or it goes down too slowly, our put options could expire worthless. At the same time, we also lose money if the stock price doesn't move. It goes sideways or it goes up. Next, our option loses value as time passes. So like a call option, a put option will lose its time value as time passes. The theta will decay. So again, hence we always exit 30 days before expiration, where the majority of the decay sets in. And like call options, our options will lose value if volatility suddenly falls. When implied volatility goes down, the price of our options will go down regardless of where the stock price goes. So again, to mitigate this risk, we want to buy put options or call options when implied volatility is relatively low. So these are the advantages and risks of buying puts. So let's go through the checklist of when do we buy a put. So once again, step one, you have to identify a bearish trade on a stock, index, or ETF using technical analysis. So again, refer to the lesson on TA to know the highest probability trade entry to go short. So it is usually when the price makes a rally on a downtrend, hitting a resistance level or breaking down from a consolidation pattern. And it's a weak momentum stock or ETF that you like to short. So once you identify the trade, check the IV percentile of the stock you want to short or you want to buy an option on. And again, the IV percentile ideally should be 40% or lower, which means volatility is low, options are relatively cheap. So again, you always want to buy low and sell high. So if IV percentile is above 50%, just know it's more risky to buy options, whether calls or puts, unless you've got high conviction that the price will move strongly in your direction. In this case, moving down. If you're convicted, then fine, you could buy expensive options. But again, to be safe, best if volatility is below 40%. Step 3, check the option chain. So click on the option chain, and the first thing is to select the date to expiration you're looking at. So like in buying a call, when we buy a put, you want to get at least 60 days to expiration. So we could exit at a profit or loss within 30 days to expiration. So the final 30 days, we exit before that happens, because that's when the option loses most of its time value. And we want to get out with some extrinsic value left in the option. Next is to choose a strike price. So again, you could buy the option that is deep in the money, at the money, or out of the money. And once again, there are pros and cons to each approach. So I prefer to buy options that are at the money or slightly in the money. So I look for delta between 0.5 to 0.6, which is about one strike in the money. I then choose the number of contracts to trade. Again, minimum is one contract, which is 100 shares. So choose the number of contracts you want to trade. Ideally, the total premium, which is the total risk, should be less than 2% of your net liquidation. So once again, if your total capital or net liquidation is 10 grand, your total risk should not be more than 2% or $200. And once again, most of the time, I will not allow my trade to lose all its value. I'll exit at a loss once options lose 50% of their value, which means my actual risk is 1% of my capital. And once again, like I mentioned, if you have a small account of 2 to 5 grand, that could be challenging because one contract on 100 shares is often quite a big sum with a small account. So in those situations, you may risk up to 5% of your capital, knowing that you will cut loss at 2.5%. The next thing to do is to always click on the Analyze tab to plot the risk-return profile. So you can see exactly your max risk, your break-even point at expiration, and your break-even point 30 days before expiration. So once you plot the graph, take a look and ensure that 30 days before expiration, if you exit, what's your break-even price and what's your expected profit or expected loss at different prices. So once you feel that it's a great trade, your risk return is in your favor, place your buy order once the market opens. So you can place a buy limit order. Again, you can place a buy order at the ask price if you want to get it filled straight away, or place it at the bid price, or place it at the mark in between the bid and ask. Once again, if you notice that the bid and ask price is really wide, there's a wide slippage, more than 40 to 50 cents, you may want to give this trade a miss. So these are the steps to long the put. All right, so now that you know how to enter a put option, let's take a look at how you exit the put option with a profit or at a loss if it's a losing trade. So again, there are two scenarios, a profit scenario and a loss-making scenario. So the first scenario is the one that we like. So we buy the put, and when we buy the put, the stock price falls fast enough to our target price. So the moment that happens, we can exit our puts for profit. So recall that for put options, when the stock price goes down, what happens to our put options? That's right, they rise in value. All right, they rise in value. So we buy the put at a low price, we sell at a higher price, we make that profit. Minus the premium, we get a net profit. So we sell the put options at our profit once the stock has reached the target price. Or we can sell the put options once it has doubled in price. So for example, we buy the puts at $2, for example, and the stock price crashes and our puts are now worth $4. So our puts have doubled in price with 100% return, we can exit. Okay, that's a pretty good profit. Okay, or we sell the options before it reaches 30 days to expiration to avoid the fast decay. So you either do A, B, or C, whichever comes first. All right. So if your options double in price, exit. If the stock price reaches the target price, exit. Or if your options are hitting 30 days to expiration, exit, whichever comes first. All right, so the second scenario is a losing trade. We buy the put option and the price doesn't go down. The price goes up or the price remains sideways. So when that happens, what happens to our put option? That's right, it doesn't go up in price. In fact, it will go down in price, you lose value, and it may expire worthless. So we don't want that to happen. So the moment we see our put options losing 50% of its value, we cut our loss, we get out, we look for the next trade. Or again, we reach 30 days to expiration, or we find that the stock price is no longer on a downtrend. Remember, the reason we shorted the stock was because the stock was on a downtrend, like so, making lower highs and lower lows, right? And we shorted it over here, we expected it to go down. So if it reverses into an uptrend, it makes higher highs and higher lows, no longer a downtrend, the trend is not in our favor, we exit the trade with whatever loss that we have. Or if the price goes up and hits our usual stop loss, where we place a stop loss, we exit the trade as well. So again, on a downtrend, we have got these swing highs. These are called swing highs. Well, let me redraw that for you. So this is a downtrend pattern, like so. And on a downtrend, it makes lower highs. So we are doing a short over there, and we expect it to go down, and we place like a stop loss over there, a mental stop loss. So the moment we short the stock and it goes up, and it goes above this level, which means it breaks above the previous high, means it's no longer a downtrend, it's not making lower highs, we can exit our put options at a loss. So whichever comes first. Either you lose 50% of the option value, you reach 30 days to expiration, or the stock price is no longer on a downtrend, reverses trend, you exit. So again, rarely do we allow a loss of 100% of the option premium. We normally exit the trade once we lose 50% of the option premium or less. And that's how you exit your long put.